Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's the middle of the week. It's Wednesday morning, but it is also, more importantly, April 2nd, which is, of course, the Reciprocal Tariffs Day. And that essentially, I think, will dictate how markets trade, the commentary, views, everything, at least for the next 24, 48 hours is going to be around that. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, morning folks. I don't know, are you feeling liberated? I don't know who is or who isn't. But yeah, I think we're all fully strapped up, waiting for those headlines to roll in.
Well, that's right. All eyes on President Trump. And by tomorrow, this time, we should have some more clarity, at least. Some more.
Some clarity, by the way, seems to have come in last night. One of the points was, well, how are these tariffs going to be implemented? They're saying immediately.
Yeah, I was thinking about your questions, what you put up on the wall. One of those questions has been answered.
And that is an important question, not in a good way. Because, you know, if they had said these tariffs are going to be implemented in 1 month, 2 months, 3 months, it gives time for negotiation. I mean, the markets would have read it like it was maybe a little dovish, but this is now, immediately. So using emergency powers. But, you know, it's not done till it's done. It's not, it's not dull till the man's spoken. And that's going to be later tonight. I think about 1 o'clock, roughly 1 o'clock, we got exact timings now which are coming through. But about 1:30 our time is when essentially those will start to happen. Now, let's just quickly rewind the clock back to tell you, in terms of what has happened and what you need to know as we start another session. So U.S. equities were down once again, at least intraday. They were down over 1%, but they essentially wiped out those losses. We ended higher. What was the weakness triggered by? There was weak ISM data. And again, I mean, you know, the ISM number once again is showing consumer confidence, etc., is lower. Prices paid component is higher. Once again, that stagflationary kind of a data point, adding to the many that we've had, high-frequency data points, pointing in that direction for the last many weeks now. There was also the job openings data, which was also weak. But while we ended higher, maybe a little to do with positioning. S&P was up about 1/3%. NASDAQ was up almost 0.9%. I mean, names like Tesla, etc., were up 3-4% last night. But pretty choppy day into what Trump has been calling Liberation Day, Reciprocal Tariffs Day, as we all know it. And of course, he's expected to deliver remarks, as I said, 4 p.m. Eastern time, about 1 o'clock or so, 1 a.m. Later today, which is, of course, I mean, Thursday early morning. But we'll, of course, react to this tomorrow morning. Now, the important point is that White House confirmed that tariffs will be effective immediately. And I think that is pretty significant for all the reasons that we discussed. If there was some time given, if these tariffs were supposed to be phased in, which is, well, they're going to do 20, they do 10 now, and they kind of dangle 10 over everyone's heads till, you know, people come and negotiate according to what they want. I mean, you know, it would have been treated and seen as opening gambit, which is maximum, and then you kind of sort of try and walk back based on how negotiations go. But, well, if you say 20 and do it immediately, the room is lesser. And I think that is the implication. But again, I mean, we've heard White House say it. As I said, we need to see it happen to believe it, because we've heard many, many things over the last many weeks now with how these tariffs are going to be. We had, a Fed representative who said that Trump tariffs could raise both inflation and unemployment and basically create an issue for central bank and what they'd want to do. The 10-year was down 3 basis points. We're about 4.22. The oil prices went up again, almost 75. So we had about 1.5% move to just under $75. Dollar was a little mixed as you compare the broader dollar, that is compared to some of the bigger peers. Now, just to circle and tie in the levels. Now, the Nifty's managed to hold on to 23,142 yesterday. That is a number that we put out yesterday, which is a 38% retracement of the entire rise from the 3rd of March low to the recent high, which was, I think, around the 25th of March. So 23,142 is that number. The Nifty broke that, but we ended slightly above it, 20 points above it. So that becomes the first one. And of course, the next downside level then becomes the 50% retracement, which is 22,917 on the way down. Bank Nifty broke below its 40-day exponential moving average. The support zone comes in at 56.41 to 57.95. Basically, it's a gap area. It's also 5641 is also a double bottom. So this is the range which the Nifty Bank needs to protect. And of course, if it does not, the 38% retracement of the same rise that we saw on the Nifty, that stands at 50,390, 5,400 roughly. So that's the setup this morning. I mean, again, it's going to be all based as a bit of a binary kind of a thing. We don't know whether, as I've been sort of calling it, this is a clearing event for markets, a hump to get over, or, I mean, it can still surprise on the downside. And it's possible. I mean, both are possible. So maybe stay on the sidelines at least for today. I mean, you know, for large caps, etc., that FII selling bit is back. And we'll talk more about that in a bit. GIFT Nifty will come up on your screen, which gives you a sense of how we are starting absolutely flat. Like I mean, it's basically holding pattern, I guess, till we get that clarity. Surabhi.
Absolutely. And that's the sort of, you know, fate of markets around the region as well. Very, very quiet right now, waiting for this storm to pass. By the way, yesterday, U.S. Treasury Secretary Scott Bessent, he said that whatever is going to be announced on Wednesday, the 2nd of April, that would be the highest tariff cap. And then he made the point that there would be some scope for negotiation downwards from there. So you declare the highest cap, and then if the reciprocal country is willing to kind of work with the U.S. and bring those numbers down, then you could see eventually lower tariffs. So that's the starting point, and it's the highest point at which things will kick off. And then, of course, we know now that this is going to be absolutely immediate. That highest tariff cap will be in effect immediately. No waiting for any new legislation on that. So Asian markets, what are they doing? They're just treading waters. Very, very quiet out there. Not too much movement. You're talking about a 0.25% up or down, depending on which market you're looking at. The Nikkei is flashing a little bit of red now. The Hong Kong market is still slightly positive. The Hang Seng, you can see there, it's up about 100 odd points at this juncture. There continues to be obviously that sense of unease in the market, which is why risk haven assets like the yen, they're continuing to be pretty well bid. The yen is still below 150 to the dollar. There you see 149.82. So it gives a sense of the unease that's playing out in the market. Okay, now for us, the issue is that the market here, the Nifty, has repeatedly been making lower highs. Last 4 sessions or so, we've been making lower highs ever since we hit the 23,800 marks. There's distribution in the large cap space that's very, very clearly playing out. The Nifty yesterday lost the 200-day exponential moving average. It lost the 50-day regular, the daily moving average as well. So the weakness has been becoming a little more persistent. And the VIX yesterday, by the way, it was surging big time because of all this uncertainty. Almost 9% rise on the VIX, and we are about at around just under 13, just under 14 for the time being. Now the flows picture, and this is the slightly more worrying part. March was a lot better. April so far not that great. I mean, Friday we had a big sell number of over 4,300 crores. Yesterday selling was almost 6,000 crores, 5,900. Domestic institutions, as usual, are offering some support, 4,300 odd. So the FPI selling resuming is a bit of a worry point. Not too many major stocks in focus. It's more global today in nature as we're starting with the overall setup. Coal India has hiked prices by about 10 rupees a ton for various varieties of coal. So let's watch out for that. Moil has hiked prices on various grades of manganese ore. By about 0.5% to 0.3%. So some of those PSU names, the miners, will be in focus. And by the way, I'll just end with the interesting comments coming in from the Parliament, from the Finance Minister in the Parliament yesterday on divestment, since PSUs have been such a flavor. I think it was in response to a question about the divestment target. She said FY25, we didn't put in place a divestment target because the government is taking a quote-unquote calibrated approach to divestment. And this gradual dilution in stake is also in the interest of minority shareholders. Remember what used to happen earlier? Suddenly an OFS is announced and then the stock would be under pressure, that particular PSU stock. That's not happening. And she says that's why we're taking a calibrated approach. So let's see. But yeah, Nigel, we have this volatile next 24 hours to navigate now.
Well, that's right. And the FI, the net selling that we see in the cash market, that's something that's making you a little bit uncomfortable. And what they've done in the last couple of trading sessions is they've unwound some longs and they've added some shorts. So that's what they did even in yesterday's trading session. Now the short positioning moves up to around 69% or thereabouts. But on a low base, both the FIs as well as the clients, well, they are piling on their respective positions. So if you look at the FI short positions, that's doubled, from the start of the series, just two sessions into the series. But that, in fact, has doubled. And even the client longs from very, very low levels, that's tripled. As of now, both of them, FI is net short and the clients net long on, on the index futures. What did the clients do yesterday? if you look at it, they were lightening positions, both on index futures, even on stock futures. But they seem to be playing this event big time via the options data. And that's precisely what it suggests. Just take a look at it. Massive addition on the call as well as on put side. But overall for the market, the PCR has come down, which is telling you that yesterday there were some puts that were written, they got unwound, and the calls, they got stacked up. So that's why now the PCR has come down to the lower end of the range. And just take a look at that. 23,400 call, 23,500 call, extremely active. However, the 22,800 put as well did see some activity. And going by this particular data point, which is the 23,400 call, which saw aggressive writing in yesterday's trading session, you get your near-term resistance that you're looking at. This is 23,450. That's the level that we're looking at. While on the downside, till the 20 DMA is protected, well, you'll say pretty much everything, is okay. This is the line in the sand. You don't want the 22,800 odd mark to get broken. On the Nifty Bank, two levels we're looking at. Yesterday, the 200 DMA got broken, which was a bit of a problem point because it got broken and we ended below that. The next reference point comes in at around the 100 DMA or thereabouts. The PCR, if it moves down to around 0.7 or thereabouts, normally we see a bit of a bounce. The 22,800 mark, that's extremely crucial going into the big event. So let's see how this plays out.
All right, no, it's a big one, and we'll see what happens. We have someone, who's been closely watching this and has got lots to say. Marco Papik is Chief Strategist at BCA Research. Marco, good to have you with us here. Thanks very much. I remember you, I wish we had that. I think you'd put out was it a meme? Various stages of Trump tariffs, right? And I wish we had that for our viewers. It was quite funny, but also actually was true to the point. What's your sense now? Moment of truth is here later tonight. How will this play out in your opinion?
Well, I think that Liberation Day, as it's being called here in America, strangely, I don't get a day off or to raise prices on my clients. But anyways, the Liberation Day, April 2nd, of course, is coming. And I think that the reason that Scott Bessent comments were important, and I'm so glad that you introduced him. Not many people in the markets are actually picking up on that, but that's a very crucial point. This idea that this is the highest level we're going to get. In other words, we could have April 2nd come in pretty hot with a very, very high level of tariffs, a pretty shocking moment, lots of selling, lots of VIX going up, but it may be the peak in deglobalization hysteria. And so that's how I would reference this. I think that that's the most important point, that this will be the worst, the moment when every new news item after this, in sort of rate of change terms, becomes better and better.
But Marco, that's is that so? You're saying that is not priced in? I think I have read a fair bit which kind of points to that, a maximalist kind of approach, like an opening gambit, which is high. And then you kind of walk back from there. You work back based on negotiations and how things go. I mean, it's tough to say what is in the price, right? I mean, we don't know what is the news and then what is in the price. But that is kind of understood, isn't it? Otherwise, I mean, the markets. Are you saying the markets see a relief from that point on? I mean, how would things pan out? They shouldn't sell off if that is not in the price. If this is known, right?
So I would say that, yeah, you're right. I mean, I think that there could be a pretty interesting buying opportunity from April 3rd and 4th and onwards. And then, of course, the question becomes pretty technical, which is, okay, fine, it's an opening gambit, it's a negotiating tactic. How long will it take these negotiations to happen? That's where the fundamental economic data will drive price action going forward. It won't be really the back and forth on trade negotiations. It will be like, well, look, I mean, if the negotiations to lower tariffs take 18 months or 24 months, as most trade negotiations take, well, then we could have a global recession while you're figuring out, where to end up. So I agree that there will still be a level of uncertainty, but I think that the fact that the Trump administration has pivoted pretty hard away from some other verbiage towards this kind of idea that they're just simply seeking fair trade and that they want to lower tariffs, I think that that is extremely positive. So what kind of verbiage have they pivoted away? Just to be clear, just to answer this question, remember when tariffs were about raising revenue for the US Treasury? Remember when it was about punishing the rest of the world, which has been free riding and which has tasted sweet taste of liberty thanks to American sacrifices? That's where we were 5 months ago. That's where the verbiage from the White House was. And now suddenly, no. It's just an opening gamut. We just want India to lower tariffs on America. Well, wait a minute. That's not what you were saying 3-4 months ago, when this was really about financing American tax cuts with raising prices on, Indian imports or any other imports. And I think that shift in rhetoric is extremely important, and we should acknowledge it.
A reality check, Marco. That's what some of the commentators here in India, some of the big market watchers have been saying, that finally the U.S. administration is going to be in for an economic reality check. Prices, costs, commodities, final output, productivity, all that is hard math, and you can't take away from that. And eventually it'll prevail. So I really want to believe what you're saying. I got the same sense that you start with this, big opening gambit, then the reality, then the negotiations. You give some, I give some, and then we come down to sort of better levels. So perhaps this indeed is the worst, the peak, and then for markets it just gets better from here. So in that context, tell us what you've been doing last couple of weeks. Have you been sort of hedging your bets when it comes to U.S. equities? Are you looking outside the U.S.? If yes, which markets?
Well, yes, as you guys know, I've been favoring this kind of tilt towards the rest of the world. I think, ironically, Trump's America First policies have pricked the bubble of American exceptionalism. That's how the market that's what the market has been telling us. So it's European and Chinese markets, even EM, broad EM, that have outperformed the US. Dollar has been declining. I think that we're in a secular shift towards that. So I think the next 5 years are going to see outperformance of EM and Europe and Japan relative to the US. I'm not shifting away from that. But in the short term, I think it is a correct move to kind of stay on the sidelines and not be sticking your head out with anything, whether anything risk on. I think gold has been a great hedge for the last month that I've been playing. Yen, less so. Surprisingly, yen hasn't really rallied relative to the dollar, but that would be my other hedge as well. So those are my two favorite hedges for kind of surviving the next moment of turbulence. Your point is reality check is coming in. It's already come. The 10-year yield has not come down as much as it should have, given the increase in recession probabilities. And that's telling you that those long-term inflation expectations, thanks to President Trump's policies, are already feeding into actual market moves. So borrowing rates in the U.S. continue to be uncomfortably high, even though recession risk has gone up. And I think that's something that folks in the White House are watching very carefully.
Hi, Marco. Good to see you on the show. Marco, talking about yields, the difference between the Indian bond as well as the US bond, that's come down drastically, right? And sometimes that's a recipe for, the domestic currency seeing some kind of weakness. And it could be followed by FI selling as well. The flows here into India in the equity markets have been mixed. We had a burst of a week or so of a good amount of inflows, and that's reversed as well. What kind of feedback are you hearing from the foreign institutional investors with regard to the Indian markets? Because we were expensive at one point of time, but those valuations have pulled back now. Your take?
Yeah, so I think there won't be an instinctive, reactive move into India like there was in 2018 during the last trade war, where India was seen as a kind of a safe haven because it's such an insulated economy. In many ways, I think that the world is just different between 2018 and 2025. You're right, valuations have improved. I've been relatively bearish on India for the past 12 months because of those valuations, and I do think that flows are going to return to emerging markets. I just don't know if India is necessarily the top of the pack, and this is kind of the same answer I always give you. I think India is going to be okay. I just don't think it's going to be the best performing market, as it was, if you remember, from 2020 to 2024. I'm asking you if you remember. Of course you do. It's been a great 4 years for India. But I think that the delta in Indian performance is going to slow down. I don't think it's going to be my number one pick in emerging markets, but I'm also not bearish.
Why is that, Marco? Very quickly, 30 seconds left. So what are you liking more than India? Why wouldn't India get the lion's share of that flows benefit?
So I think that there's two answers to that question. I think we're in a commodity secular bull market, and I think that's going to continue. So if you look at the price of commodities, for example, over the past 18 months, even when China was effectively plumbing lows in terms of its economic performance, commodities actually held up. And I think that's an incredible setup. If China so much as shows a pulse, if China so much as shows a blip of life, I think commodities will be on fire. So that's number one. And in emerging markets, I think India is often sort of fighting against commodity producers for that attention from institutional investors. The second reason is that I think there's a huge right tail risk for Chinese equities and Chinese assets. Now, I say it's a right tail risk. It's a positive. It's not my base case scenario, but there is the chance, and I think it's pretty substantive, like 20, 30%, that there is some sort of a grand bargain between the US and China, and that will recapture some of that attention that China lost, which again will sort of push India down the list of favorables for institutional investors. It's not a knock on India or what's going on in India. It's just more from a valuation perspective and from a interest perspective. Other stories may capture the imagination of institutional investors.
Marco, very, very quickly, just one last point. We heard some over the weekend comments with regards to Russia, Putin. Apparently, Trump was angry. What does that mean? Does it mean that maybe we're not going to see a ceasefire soon? Will that force a ceasefire sooner than expected? How is that developing according to you?
Well, I would just say that too many people overreacted to the Zelensky meeting. There was this sense that America's abandoning Europe. It's not. Trump just subjectively wants the war in Ukraine to end, and he's going to just be mean to everyone who stands in the way of that, whether it's Zelensky or Putin. But one thing that I would say, your chyrons on the screen are talking about oil. And I do want to point out that oil prices could be in for a surprising increase, in part because Trump is now threatening secondary sanctions on Russia, which of course would affect, for example, Indian corporates that are buying it. But also, there is something we didn't talk about today, which is strikes against Iran, which could be threatened over the next couple of months. And so I would focus on that as well. And that's maybe a topic for conversation for our next gathering.
Got it. We've made note of that. And absolutely, yeah, we had a chartist yesterday, by the way, was calling $90 plus on Brent oil. So who knows, never know when it's geopolitics. Anything's possible, right? Marco, thank you so much for joining in. Good conversation as always. All right, with that, let's quickly move on and talk about some of the other interactions that are lined up on the show today. Coming up at 8:35, we'll have Peter Maguire of Trading.com to actually put the spotlight on commodities in a more deeper way. What lies ahead as these tariff negotiations roll on? At 9 o'clock, we have Praveen Sahai, who's the analyst at PL Capital, to talk about the consumer durable sector as the summer season sets in. Pradeep Bhattacharya of Edelweiss Mutual Fund is our market master of the day. He joins in at 9:20. At 9:30, we chat with Mr. Vimal Kejriwal of KC International. Company's been backing lots of orders as the last fiscal year ended. After that, we have a full discussion on the trade and tariff issues coming up. Anup Padhavan, former Commerce Secretary, and Abhijit Das, international trade expert, will be talking to us about the current issues at play. At 9:50, Lalit Agarwal of V-Mart Retail joins in to talk about demand trends. And finally, in our special segment, Indianomics, Lata today will be in conversation with Dinesh Khara, former chairman of State Bank of India, S.S. Mundra, former deputy governor of RBI, and Srinivasan Varadarajan of Union Bank of India to talk about how the Indian banking system is going through a structural shift.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. For the time being, I'll run you through the list. We're looking at Hyundai, NMDC, Coal India, CSB Bank, SBI Cards. All of them will be reacting to positive news flow. Add to the list V-Mart Retail as well. On the flip side, Hindalco, Tata Motors, MCX and RITES will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. So some of the markets are flashing a little bit of green across Asia. The Hong Kong market's actually doing okay. The Australian market's up about 0.25%. The Nikkei that was in the red has now, turned towards the flat line. So that's how it is. Keeping fingers crossed. That's the mood across Asia. Let's get at the implied open up. It was very quiet last week. Checked it. Still the same, just about 4-5 points up. That's how we could actually start up. Okay, let's straight away get to the stock list of the morning. Plenty of names to watch as always. We have our team standing by with the CNBC TV18 list of top stocks to watch. Guys, morning to all of you. Nigel, some news coming in on Hindalco. What's happening?
Well, that's right. Hindalco, they had their annual meet and they've given the broad takeaways. So just run you through a few of them. They're saying that Novelis in the near term will return to the Q2 FY25 profitability, which means it'll be closer to around $500 per ton. That's good. They're saying the longer term guidance of around $600 per ton, that holds as well. That's positive. They said that before. They're talking about, moving to 75% recycled content from around 63% right now. That's at Novelis. Novelis, the growth capex has been maintained at around $5 billion. No worries on that front. I think the problem will be on the Indian capex, and that could be the lone point that could pressurize the stock. Otherwise, everything else is more or less in line and more or less positive. The Indian capex has increased from around $1 billion that they had outlined earlier to around $5 billion odd. And the capital allocation priority is, they say, that the debt to EBITDA will be maintained at around 2x on a consolidated level. Phillip Capital, they have a buy rating on the stock with a target price of around 760 rupees. However, they are talking about this FY27 capex number, which is expected to peak at around $4 billion, $2 billion for India, $2 billion for Novelis as well. And because of this capital-intensive year, they say there could be a bit of a mismatch on the cash flows, which could be a bit of a risk to the stock in today's trading session. So because the Indian capex has been increased, I expect some kind of pressure on the stock in today's trading session.
Oh, okay.
All right, Nigel, thanks very much for that. So keep an eye out on this one on the downside. Auto sales numbers, we've been, of course, telling you what's been coming our way. Sudarshan is here with a summary. So over to you.
Morning, Prashant. So today I have two stocks in focus. First one is Tata Motors. Here I'm going with red despite company reporting sales that were higher than estimates. And the reason of going with red is because it's underperformance against the peers. Talking about the CV segment, it has shown a decline of 3%, while for Ashok Leyland, the growth was at 15%. In the passenger vehicle segment too, it saw a minor increase of 3%, while on the other side, M&M SUV segment saw a growth of more than 23%. Even Maruti has shown a growth of almost 6% for its utility vehicle or say SUV segment. And that is the reason I'm going with red for Tata Motors. Next up is Hyundai Motors. Here, total sales were higher than estimates, and the main contributor remains the SUV segment. Its Creta remains the highest selling SUV in India, and in FY25, SUV's share to total sales for Hyundai remains around 70%. That's the highest that company has reported in the recent times. Also, the total sales were up nearly 3%, with both domestic and exports seeing a healthy increase. And that's the reason I'm going with green for Hyundai India.
Okay, all right. Thanks a lot for that, Sudarshan. Well, I'm looking at two more stocks, NMDC as well as Coal India. Now, we have the operational performance that's coming for NMDC. And it looks actually pretty good because, remember, they had a strike in the past month that would affect the numbers. And even taking that into account, actually, they've given a mid-single-digit growth in the total sales numbers, which is heartening because at Chhattisgarh, those numbers were hurt by the strike that was there. So on expected lines, that's lower. But they seem to have made up most of that at Karnataka. And that's why you're getting a mild growth. Though for the year, it's more or less flattish, expecting a bit of a green tinge on NMDC. Because of this operational performance, and as Sudarshan said, maybe that higher royalty tax in Karnataka may be pushed back a little bit. So we'll have to see how that pans out. Tinge of green on this one. Coal India, a very, very minor increase is what they've taken of around 10 rupees per ton, both for the coal, for coking coal, as well as for non-coking coal. And it's for both the regulated as well as the non-regulated sectors across Coal India. They're saying that the contribution of this will go to a particular corpus, which hasn't been factored in by the state. And it comes into effect from the middle of April. So mild green on the stock is what we're going with. Just a 10 rupee increase per ton. But let's hop across to Vamakshi. She's here to tell us about MCX. Vamakshi?
Well, Nigel, good morning. MCX has, will be in focus on the back of a trading activity update going with the red for this counter, and that is because, as per Morgan Stanley, MCX transaction revenue stood at 289 crores in the fourth quarter. This is a downtick of almost 4% as compared to the previous month, and it is also a tad bit lower as compared to Morgan Stanley's own estimate of 293 crores. The average daily transaction revenue stood at 3.9 crores for the fourth quarter. This is slightly below Morgan Stanley's estimates of 3.9 3.95 crore. Now keep in mind that Morgan Stanley has an underweight call on this counter, target price of 3,400, which is significantly lower as compared to where the stock is trading today. They're building in 4.02 crores of ADTR in FY26 and 4.19 crore for FY27. UBS also has a note that has come out on MCX. They have a buy call, but they've gone ahead and cut their target price from 7,800 to 7,250 crores. They believe that the volumes this time around indicate a soft quarter, but they're expecting the volumes to improve further on. Overall, they're expecting the quarter 4 revenue to decline by almost 5% sequentially. So therefore, going with the red for MCX.
Okay, that's a classic tug of war, bull versus bear, between the views coming in, UBS on the bullish side and Morgan on the bearish side on MCX. Got it, Pamakshi. Thank you very much. Over to Abhishek then. Some of the quarterly updates have been coming in for CSB Bank, I think, and SBI Card. Abhishek?
Well, to begin with CSB Bank, it's been an outstanding quarter for them on a sequential basis with respect to the business momentum. Take a look at deposits. That's grown by 24% YOY and more than 10% on a sequential basis. Calculation shows that the CASA ratio might have improved quarter-on-quarter by about 10 basis points, which is heartening to see. Gross advances are up nearly 30% YOY and about 10.1% quarter-on-quarter. In this, the gold loans have grown at 42.5% YOY and about 4.5 to 8% on a sequential basis. The gold loan share has increased to has declined on a sequential basis, but it's improved on a YOY basis. X of gold loans, the total loan growth is at 25.3% YOY and about 11.65% on a sequential basis. Now RBI has given out credit card data for the industry. So for the industry, the total card issuances have grown by 8.7% YOY and about 0.4% sequentially, but the spends have declined massively on a month-on-month basis. So overall, the spends have declined by 9.2% month-on-month, and average spends hence have declined by 9.5% on a month-on-month basis. For SBI Card, the total card issuances have grown by 10.2% YOY and about 0.9% on a month-on-month basis. The spends have increased by 12.5% YOY and declined by 9.7% on a month-on-month basis. So average spends over there have declined more than 10.5% on a month-on-month basis. So take a look at the market share. The credit cards, overall the total number of cards, that market share has improved both YOY and month-on-month. However, the spends market share has declined on a month-on-month basis. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's wind this down with Vinny, who's here to tell us about V-Mart Retail and rides. Morning, Vinny.
Good morning, Nigel. So starting with V-Mart Retail, Q4 update that has come, and a good update is what we could call it, because revenue seen a growth of around 17%. This is for Q4 itself. Overall, V-Mart Retail's revenue, that's seen an improvement of 18%, and LimeRoad continues to be a bit under pressure. That's seen a decline in terms of revenue of 47% on a year-on-year basis. Now, same-store sales growth, that's an important one for the retail company. Q4 same-store sales growth has come in at 8%, while for the full year, they've seen a growth of around 11%, and V-Mart itself has seen a 7% improvement in terms of same-store sales growth. Overall, when you're looking at it in terms of commentary compared to Q3 also, they have done well and in line with what the company had highlighted. They said that the revenues would be in that mid to high single-digit revenue growth, and that is what they've achieved in terms of for FY25. So we're expecting green coming in on the screen for V-Mart Retail. Other than that, rides, a bit of an issue coming in on this front, because rides and the UP State Bridge Corporation, they have actually terminated one of their agreements. Now, rides is saying that this was mainly due to some interpretation issues that they had in terms of the agreement. No work had started still for the company, but and they're not going to see any financial impact, but still this is a big contract that is for the company which they have lost. So that is why we could see some bit of a red coming in on the screen for rides.
Okay, all right. Got it, Vinny. Thanks very much. By the way, on V-Mart Retail, we'll be touching base with the management. They will be joining in at around 9:50 this morning to talk about demand trends and, of course, the outlook for FY26. Let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow around them are Hyundai Motors, NMDC, Coal India, CSB Bank and V-Mart Retail. The ones that have negative news flow around them, SBI Card, Hindalco, Tata Motors, MCX and RITES. Okay, we'll take a quick break, come up on the other side, and we'll talk commodities. What do these tariffs mean for the commodity universe? The huge rise in gold. Peter Maguire of Trading.com will join in.
Welcome back to Bazaar Morning Call. Well, we've told you about the equity markets, but the commodity space is buzzing around. Manisha Gupta joins us to help us out with a complete wrap of what's going on overnight. Morning, Manisha.
Morning, Nigel, and thank you for that. Well, I'll start with the gold prices because we finally seem to be taking a bit of a breather after a string of record highs. Well, let me tell you that in this year, we've seen 20 days of all-time highs already, and we are up by nearly 19% for the gold prices in this year. A lot of safe haven money, new money, and a lot of alternate money really seems to be flowing into gold right now. We've seen 10% of gains in the previous month itself. Well, ahead of tariffs, the volumes in the Asian markets are slightly on the lower side, but we still are holding about 3,100 and not too far away from that all-time high. What has seen profit taking, though, has been metals as a sector. Silver fell 1.5% overnight. Copper was down 0.5% as well. But because the dollar index also is declining, there is some support we've seen coming because of that. And finally, about the crude oil prices, we did see 5-week highs yesterday, but that has come off a bit ahead of the reciprocal tariff announcement today in the evening. The U.S. crude inventories also surged by 6 million barrels. And for crude, more importantly, it is going to be about the OPEC and allies meeting. Earlier, it was scheduled for 5th of April. Now it is rescheduled for 3rd of April. And there is an expectation that you could be looking at an approval of a hike of 135,000 barrels per day from the month of May. So plenty happening. And in addition of that, you also have the U.S. non-farm payroll data that comes in on Friday. So the rest of the week, clearly, very, very volatile.
Oh, absolutely. It's almost dizzying, Manisha. So many cues, right? And on oil, like you said, the U.S. inventories are higher. Then there's this OPEC meeting. And then there is Trump saying that he's very, quote-unquote, pissed off with Putin. So, yeah, there's a lot going on. Thank you very much for wrapping it all up for us. Let's actually, take that point forward with Peter Maguire as well, CEO at trading.com. Now that this big day is finally going to be behind us, 24 hours from now, what is the commodity world looking out for? Peter, hi, great to have you on. I want to start with gold. I mean, it's been sort of the mother of all bull runs, at least in the last 12 months, including, of course, this calendar year. But a lot of commentators are saying that maybe April 2nd is the peak of the tariff tantrum. And then you gradually start moving to more certainty. The numbers are known. The negotiations start getting known. Do you see gold anywhere close to a top?
Well, good morning, Surabhi. I mean, lovely to see you. I think the overall momentum, and building on what you have just said, and certainly what Manisha mentioned, it's been extraordinary. You can't take your eyes off that 19% up to the upside since January 1, that 3-month window, extraordinary. Now, whether we're going to see whether we're at the top now for the next 3 to 6 months, or there's further legs to run, 3150, 3250 are those sort of psychological barriers, and everyone's focused on 3250 as the key number. Now, I'm conscious as far as President Trump, we all understand, and no one knows until 2000 GMT today when we get that drop from, and how he explains moving forward. So, Surabhi, I'm still believing that there's much more upside over Q2.
Peter, you said that would be the first port of call. And what's the next medium-term level?
I think it's got to be 32.50. I feel as though that overall momentum, if it was to put on another $100, that's the big psychological barrier. And that's what many analysts are saying is the real key driver. If it gets to that number, then I think we're really going to see some, further horsepower to the upside.
Hi, Peter. Good morning. Good to see you, Ben. One bearish call or one point that people have been raising is the gold RSI. That's moved to 70 plus levels, and normally we see a bit of a pullback, but it appears as of now it's got the momentum with it. The other question I wanted to ask you is on silver, because many are talking about silver actually being a better play, and from here on maybe it outperforms gold. Are you in that camp?
Yeah, I am, Nigel, and good to see you. And I think a couple of things. I'll answer the silver one first. We've had 2+ decades of underinvestment across that whole capex moving forward, and when we look in retrospect. So for the gold to silver ratio, I think it's very much out of kilter, and I think that you probably see further up, not only further upside for silver, but really start to take some big leaps forward. And I feel as though that you'll see a narrowing of that relationship between the gold to silver ratio. I'm not prepared to go out there on a limb, but you've only got to divide one by the other, and that'll tell you where it is at the moment. The other side is, as you mentioned, the overall US dollar impact, what's happening as far as risk, where does the rest of the world see it? Precious metals seem to be the place to be, and it's certainly everyone's focus at the moment.
But beyond the very near term, right, and markets will, they're forward sort of looking mechanisms in that sense. If the US, the Trump administration is able to do some of what they are wanting to do, lower the cost of debt, lower deficits, et cetera, I mean, that is long-term positive for some of the other risk assets and not exactly safe haven assets like precious metals. Would you agree with that?
Well, I do agree with that in a lot of ways, Prashant. Good morning. I feel as though that there are so many moving parts with this. You've got huge central bank buying, if I look at the gold situation over the last, let's say, 5+ years. Secondly, retail investment, and India is just a classic case. People storing it as and you've been doing that for hundreds, if not thousands of years. And that momentum seems to be picking up across the fabric of society. And that's global. And then, of course, you've got the paper market, and then you've got the other side, the fear entering the markets. Where do people see? And if President Trump, as you mentioned, is able to pull off all of these major structural changes, which would in turn boost the US economy, one would think that maybe a little bit of that hot air would come out of gold. But again, this is a work in progress, and at the moment, it's very hard to stand in front of this train, because I think you'd get run over by it.
Yeah, absolutely. Not that too many people in India would be complaining. I think they've been on the train for many years, like you're saying, right? So they're happily riding along. Peter, on oil, and oil is interesting. Yesterday we had a chartist who suddenly said that he's seeing $90 on the charts. I don't know how, because Manisha was telling us that OPEC is getting ready to pump more. Trump is all about drill, baby, drill. The only outlier I see in the situation is that ceasefire not going through. Because they're still talking around it, Russia-Ukraine. What's your sense on oil?
Well, Surabhi, I mean, that's right. But there would have to be, I think, for that to hit $90, and I'm not in that camp at the moment, but that would be, I think, a geopolitical play. And that would be something dramatic happening as far as Strait of Hormuz, and there'd be an attack of some description, I think, on Iran for that to materialise. And let's just hope that we don't go down that side of, from an economic and from a warfare side. But that would be, I think, would underpin from that geopolitical risk premium built into it. I agree with you. I think President Trump's going to increase it. The Gulf, as he renamed it, Gulf of America, he is going to add value and really drive production. So there's the first side. And I think OPEC are going to certainly pump more. So I'm looking over this Northern Hemisphere summer, actual softness across the crude market as far as price.
And in terms of levels then, since you're not expecting any sort of a spike unless there's some outlier geopolitical event, but otherwise, what's the range for the summer?
Well, I think I would like to be under 70 for Brent, and I think 65-ish for sort of WTI. If it was to break those sort of numbers and further downdraft, I'm conscious as far as US dollar. I'm really conscious as far as what's happened with equities over the last couple of months. There's so many components to this, and naturally you think of far as what happens with US dollar. The bond yields, 4.2 for the 10-year, all of these factors. So, yeah, I'm thinking weakness, and, there's plenty of crude out there.
Okay, well, it's good for us, Peter. We can do with oil staying stable. We're a large consuming country, right? Thank you very much for joining in. Good to have those views with you today. All right, that's Peter Maguire. With that, let's move on. Just about 15 minutes before we start getting our pre-opened rates, we have Devin Choksi joining in for some ideas. Devin, thanks for being with us. I'll start with the big event. Everyone's talking about this whole tariff business. We'll eventually get that number. Let's start with the pocket of the market that has the maximum amount of exposure. I mean, textiles is still a smaller part of the market, but pharma is big. A lot of these companies are exporting to the US. What would your advice be? Have you been advising clients to reduce exposure at all?
Yeah, good morning, Surabhi. Well, we are of the view that the pharma being an essential item, probably I think the tariff business would be the least, I think, which will get impacted with as far as the pharma is concerned. And maybe I think we are likely to see some corrective actions, I think, happening on that front, at least if not others. Because I think that's where probably US is largely dependent, including the healthcare industry is completely dependent on it. So I don't think that I think it is going to be changing big time. Maybe some indirect impact, I think, which we are not fully clear about, and that includes the duties on the chemicals, which are basically getting applied onto, could possibly have some impact on the input cost side. But that is something which we would not like to speculate at this point of time. Let the game get played out a little bit more in detail, and then probably I think one could take a view. But as of now, no negative news per se on pharma, particularly the companies which are with the specialty generics, the clients model is continuing to do well, and they will continue to do well. That's what we believe.
Yeah, all right. Hi, Devin. Good morning and good to see you, Ben. Devin, what about Hindalco? You know, they had their analyst meet where they laid down their guidance and everything looks very, very good. You know, they're talking about being prudent in capital allocation. They EBITDA per ton of Novelis. There is a path set out where it moves from the last reported, $450, $500 per ton, all the way to around $600 per ton. The problem, I think, is going to be on the capex they've lined out. For Novelis, $5 billion, no worries. On India, though, earlier they were talking about around $1 billion or thereabouts. Now they have increased that because they've put on a couple of, plans for the India business itself. And sometimes in the past, I've seen that the stock gets derailed just in the near term because of this capex going up. What's your view on the stock? If it dips today, is it a buy?
Yeah, good morning, Nigel. You're spot on, absolutely. I think the experience says that whenever the commodity companies gets into the capex program, till the time the capex gets completed, the stock prices goes nowhere. Maybe I think it forms a range, and within that range it keeps on moving. And that's what is likely to happen. The expansion program, as you rightly indicated, both in Novelis as well as on the domestic front, is basically sounding quite steep as far as the spending is concerned. And it is going to take a good amount of time before we just start getting realization out of it, maybe 27, 28 financial year. So from that perspective, I would like to think that the stock probably would remain in the range bound movement, I think, going forward. We don't have much view at this point of time, even of the commodity prices, given the kind of disturbances that we have in the global markets. So as a result of which, I think we would like to play a little bit safe. Maybe I think the market is giving opportunity at lower level for traders, but I think that's not one at this point of time for Hindalco as I see it. One will have to look at it, I think, from that perspective for at least next 2 years. The stock could remain in the trading range in this particular period.
This entire telecom, David, morning, telecom was in focus yesterday, right? I mean, Voda Idea, 20%. I think Indus was up about 5-6%. Bharti, of course, is everyone's favorite name there. Any thoughts here, David?
Prashant, good morning. Well, I think I asked a fundamental question that yes, you converted the loan into equity, agreed. The repayment part is to a greater extent taken care of, definitely a breather. What next? The CapEx program. You already have 5G implemented by the competitors, and the company is still rolling out the 4G in some pockets, and they are talking about implementing 5G. It's going to be a major CapEx program, and this program has to be funded. So one will have to be interestingly watching it out as to how this is going to get funded and how exactly the resultant benefit coming out of this particular program for the company. In my viewpoint, the re-rating might happen in the market because this market has a habit of finding some stocks happening at lower levels. But I don't think that the fundamental changes beyond a point. The breather is definitely there on the repayment side of the loan, but certainly I think the profit performance will be one thing which we'll have to look out for. So for that, I think one will have to definitely argue for the valuation at that point of time. We'll wait. I don't think that except momentum, we'll buy into the company on a fundamental basis, particularly Vodafone Ideas.
What about Trent, Deven? The stock was at 8,000 rupees, came down to 5,000 rupees. In the last couple of trading sessions, actually the stock has seen a good bounce. Even yesterday with the market ending at the low point of the day, I think the stock was up close to around 5%. One element could be that the number of stores that were added in the past quarter was better than what the street was working with. What's your take on the stock added on this 5,400, 5,500 rupees?
Adequately priced, as I see it. I think the valuation's not cheap, and I think most of the store opening, increasing the footfall, adding into the top line and the profits, everything is being factored into the price at this point of time. So maybe I think the market gets a little bit more excited at this point of time, largely because some part of the momentum was seen returning back in last 15, 17 days. in the market. And that's where probably I think some of the momentum activities are happening in counters. But on the valuation side, everything is in price. Unless I think we see meaningful time correction, probably one would not like to get into it in a hurry.
Devin, so let's just consider one scenario that today we hear about tariffs, and I mean, there is kind of peak pessimism, and then maybe the environment turns a little constructive. We don't know. I mean, it could go completely the other way. There's no real playbook here. But if that is the case, what do you think will do well from here? I mean, how to position for more constructive markets, in your opinion, in your coverage universe?
So yes, Prashant, I think it's a very important point, and we keep on fielding this situation daily. The past experience also says that I think whenever these kind of storms have happened in the universe, I think we have strongly come out with we come out very strongly and we remain winners in this particular game. I believe that I think it's going to play out that way. On one side, India is structurally bringing down the cost. We are having the renewable participation happening into the energy cost. Today, the captive power is available at a cheaper cost, and I think most of the main power companies are main manufacturing companies, be it in the area of metal, be it in the area of refinery. They have started getting benefit out of it. So structurally, we are bringing down the cost structure. Even the logistic cost structure, I think we are bringing down in the country. So in a way, if you look at it, manufacturing sector will remain quite competitive. And that's what we try and see in our portfolio stocks, whether the companies are getting benefit out of it. I don't think that the tariff business is going to play out for a longer period of time. Maybe a couple of quarters, you are likely to see some amount of jerks and maybe adjustments. But beyond the point, I think that the companies would try and adjust themselves. And that is a good part. I think we see the really strong India coming out of this particular tariff implementation activity. And that's where I think we believe that strong companies, companies with a proper approach on the cost structure will definitely remain winners or emerge as winners.
Which ones, Devin? You mentioned names, I missed it.
I didn't mention name per se, but maybe I think some of the companies within the heavy power users, particularly the metal commodity companies, the refining companies in particular, and some of the manufacturing companies who are basically resorting to the captive power are likely to be the winners in the near term, as far as I think their cost structure is concerned. And we remain distinctly positive on the possibilities on that side.
All right, fair enough. Devin, stay with us. We're going to take a quick commercial break here. We'll just come back and get you some technical view on the markets as well, right? I mean, we've bounced off important levels yesterday. So we'll get Mitesh and Sudarshan join in with what they're making of things. Stay tuned. Okay, welcome back. Just I think, 6 minutes to go for the pre-open session to kick off. Sudarshan Sukhani and Mitesh Thakur are with us with what they'd want you to do as we start another day, or maybe not do. I guess that's a more important question nowadays. Gentlemen, morning. Mitesh, to you first. What's the setup?
Good morning, Prashant. So, the setup was quite positive, and in fact, the indicators haven't declined much, despite the fact that in the last two sessions, we've had a good fall. My sense is that I think, with the first level of support being taken out, we have gone in a bit deeper, which is also okay, I think, because we're still above the daily averages. And therefore, I would be watching levels of 23,100 and then 22,950 as the bigger 150-point support range. Today, we might open flat, which means that we might be around 23,100. My sense is that if we don't break below these levels, then I think in the next few days, we should start some kind of an up move, because the indicators are still, as I mentioned earlier, are still strong. The Bank Nifty is even better in the sense that the averages are at about 50,200 odd levels, but there's a gap support around 50,700, 680 zone. So as long as that is not being filled, I'll maintain a positive bias. So overall, a positive bias, though a bit worried about the fact that in the last 3-4 sessions, as the markets have given a pullback, the hourly charts have slightly turned negative, but I think the overall strength is positive. So we'll maintain the positive stance.
Okay, that's interesting. So keeping the positive view intact on the indices. Got that, Sudarshan. Got that, Mitesh. Sudarshan, let me ask you for your view as well. Morning. What's the call on the indices?
Yeah, good morning. Well, yesterday was a surprise. I thought maybe the markets will hold on and give an opportunity to go long and buy, and that never happened. And the sharp decline was also, at least for me, it was not anticipated. So today is again a day of confusion. Now the markets, ideally, the market should stop at some point and say, okay, this is the final end of this correction, this downside move. But we don't know when that will happen. So unfortunately, I don't have a trade. The best trade is to wait for tomorrow morning.
Okay, so wait for clarity and then kind of wait in the market. Got that. What about stocks though? Sudarshan, are you trading stocks today?
Yes, and there are stocks on the long side also. Stocks sometimes do their own thing. AB Capital, Aditya Birla Capital is a buy with a stop under 181. Gas Authority, GAIL is a buy with a stop under 182. HDFC Life again is a buying opportunity with a stop under 680. I have only one intraday short, that is Tata Elxsi. That's an intraday short with a stop above 5,160. Primarily focus on stocks that are giving signs of life. Even if the Nifty were to fall tomorrow, some stocks would do well.
Absolutely. Mitesh, what about you?
I have three buys to a sell. On the buying side is Gas Authority. Keep a stop at 182, look for targets of 186. Bank of India is a buy with a stop at 108 for a target of 115. And Astral, after a long time, comes on the buy list. Keep a stop below 1288, look for targets of 1350. One sell call, that's Godrej Properties. Keep a stop at 2066 for targets of 1985.
Okay, all right. Thank you very much, Mitesh, for that. So that's basically the trading setup. Three buys, one sell from Mitesh, and more on the long side as far as Sudarshan is concerned. Expecting, as always is the case, some winners even if the market tomorrow is on the downside. 2 minutes to go for the pre-open session. We'll take another quick commercial break here. We'll turn our attention also to the consumer durables space. I mean, look out of your window if you're in Mumbai and it may be sort of, cloudy and overcast, but summer is coming. What are demand trends looking like ahead of that? Praveen Sahai of PL Capital on the other side.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, yesterday we had a few stocks that were moving around in trade. And one stock that was under pressure was actually Voltas. Let's talk about the consumer durable stocks. In yesterday's trading session, there were a couple of them, besides Voltas as well, that was down. And this is surprising because summer demand is shaping up quite well, which in fact should be good for them. Praveen Sahai, the research analyst at PL Capital, joins us on the show. Hi, Praveen. Good morning and good to see you in as always. Praveen, what was the reason for Voltas to see that sort of a sell-off? Everyone's talking about pre-buying. They're saying that, the compressor shortage will not be a factor, at least initially, unless demand is very, very strong. Why was Voltas down close to 5-6%?
Yeah, hi. Good morning, everyone. So basically, see, if you look at for a Voltas prospect, definitely you are right that summer has been, so far has been good, and the way forward also the severity of the summer is expected to be a very good. Definitely the volume growth for the industry is expected to come in. Few things about the Voltas because Jan, Feb, March, usually for them, they lose a market share to the second and third years. That's a trend from the last 4 years, and that was a visible one. Second thing is there is a escalation in the prices, the cost, and that is not able to pass on. So that is the the another reason that the volume is going to be a good, but the margin may see some under pressure. Being one of the good quarter, the fourth quarter and the Q1 are the usually seasonally better quarters. And in that, if the company is not able to pass on the prices, increased cost, then definitely that's one of the concern. So I believe...
Yeah.
Yeah.
So,
Sorry.
Praveen, you're saying they could potentially lose some market share because the volumes may not be as much, and margins as well could be under pressure because input costs have gone up. Is that correct?
So regarding the market share, it's a usual trend from the last 4 years, and usually it gets recovered by the first quarter.
Okay. By the way, the rupee has opened, and there's fair amount of weakness that we're seeing. Yesterday, I think the money markets were shut. Banks were shut because first of the financial year. Now we have the opening. 85.68 is what we're getting on the rupee. Okay, Praveen, hi. I was going through your note on fans, and that's where you were pointing out that I think third quarter most of the companies undertook some price hikes. And you also say that Havells and Crompton, they've more or less managed, they've maintained their market share and they're seeing stable demand in their regions. So let's talk about this space. And I just throw in maybe a Symphony here as well. I don't know if you track that stock or not. But in the fans and cooling space, which is your preferred stock and why?
Yes, so my preferred preference right now is RAC because the room air conditioner growth is quite huge or strong. Now coming to the the another seasonal product, which is a fan, and in this quarter, the fourth quarter, we had seen there is a good improvement in the prices, so around 2 to 5% of increase in the prices across the brand. And in our channel check, that reveals. Second important thing is the inventory level at the dealer has been very strong. So that has above average. So that indicates that the primary sales has been also good for the fourth quarter for all the brands, and especially for the Crompton and Havells, because they were sitting on the higher base of a last year fourth quarter. And if the price hike and the good primary sales, that indicates a good number for their ECD portfolio for this quarter.
Okay. So Crompton and Havells, you like these two stocks. And room air conditioners, like you said, you spoke about Voltas. What about the others, Blue Star? Which would be your preferred pick? Which company is showing the maximum, the expectation in terms of growth as well as decent margins?
So the growth-wise, all the Voltas, Blue Star, or Lloyd are expected to deliver a 20 to 25% of a growth. Now here is important is to look at the margin. Who is expected to maintain their margin from here on? And Blue Star, I believe, is better placed in that scenario. That they are the benefit of own manufacturing as well as the penetration improvement, market share maintenance, and the margin maintenance is also evident for the Blue Star. So it's a better place as compared to the others.
All right, Praveen, any view on Whirlpool? Yesterday that was the lone stock that was up, but it's been the biggest underperformer in the last 1 year or so. The stock is halved from the top. But in yesterday's trading session, the one was up close to around 5% or thereabouts. Valuations seem to be in favor. The stock trades, I think, at around 27 times in comparison to 45 times in the past. The problem's at the promoter end. But any view on the stock at around this 1,050 level?
So we don't track Whirlpool, but overall, general in the category where they are in, that's washing machine and the ref. So those are definitely expected to do well, around 12-13% of a growth in the industry, and being one of the best player in that, and also premiumization is a story. So fundamentally, I'll not see any problem, especially for the Whirlpool. That is only related to the promoter, I believe, whatever the correction is happened for them.
Could it be a strategic fit for any of these players?
No, that's I can't comment on that actually. But yes, the LG is also coming up with an IPO, and I believe this sector, would be in the focus way forward.
Okay.
Okay. All right, Praveen, we'll leave it on that note. Thanks very much for joining in. That's a view on some of the consumer durable stocks, fans, ACs, coolers, as the season is coming in full bloom. By the way, we've got the pre-open rates now kind of settling in. It's very, very quiet out there. 20 points higher on the Nifty. That's all we're getting. Let's talk about any noticeable stocks on the upside. There's Coal India. Some of the consumer names are looking good, at least in the pre-open. Tata Consumer, Titan, Trent. All of these stocks are up and about. And then that's pretty much it. Zomato as well, which was up about 1% yesterday. That's also higher slightly. We have, I think, our technical experts back with us. Sudarshan, if you can hear me, before I ask you about your 9-10 call, just a word on Trent. Because of the fundamental positive news flow yesterday, suddenly Trent was springing back to life. On the charts, what do you see ahead?
Oh, the charts are excellent. In fact, Trent was in my list, but I had to select any 4, so I left it. Trent is a buying opportunity, not just for the day, it's also a positional trade. I think there's a significant upside here.
Okay, so that's on Trent separately. Otherwise, what's your 9-10 call?
Otherwise, it's HDFC Life, buy HDFC Life with a stop under 680.
Okay. And Mitesh, let's come to you. 9-10, what's the call?
Gas Authority for target of 186.
Sorry, I missed the stock. Gas Authority, GAIL. Okay.
All right, so those are specific trades which are coming through. Mitesh, just 2 other names I wanted to get your sort of thoughts on. One is HBL, which was a big mover, 514. It was ended in a down market, but it's mid-cap, smaller name, so but 8-9% higher. Any thoughts here? Huge volumes. I think Mitesh, are you there? Okay, I think the line.
Yeah, I said I'm not tracking. I'm not tracking the stock.
Okay. I didn't get that. The audio didn't come through. Thank you, Mitesh, and we'll speak again. Let's talk about the standout brokerage note this morning, which Nimesh is going to bring to us. Nimesh, morning. What do you have?
Hi, morning, Prashant. So today's standout is on Tata Consumer. Interesting note from Goldman Sachs. They've today upgraded the stock to buy from neutral, and they have a target price of 1200. Now, for Tata Consumer, the company has been struggling with earnings for the last many quarters. Now, Goldman Sachs believes that it's at an inflection point, and from here, the company is poised for a strong EPS growth over FY25 to FY27, and that's going to be largely driven by a couple of factors. One, recovery in the tree margins because they've raised the target, they've raised the prices there. 2, strong innovation and distribution expansion on the growth businesses of Tata Consumer, and 3rd, lower interest cost as acquisition debt has been paid off. So these are the 3 reasons why they believe earnings will improve from here on, and hence they've raised the FY26, FY27 EPS estimates between 3 to 7%. And Goldman believes that within the consumer basket, this is one stock, one company which is going to report the strongest earnings. So on back of all this, a big upgrade on Tata Consumer to a buy now, and they've raised the target price to 1200 on Tata Consumer.
I think Gurmeet is a big fan of Tata Consumer. I remember I would probably ask him to be pleased to read this. But thanks very much, Nimesh, for that. 2.6 higher. It's a 25-26 rupee move on Tata Consumer this morning. Let's revisit Hindalco and the metal space as well. Nigel, tell us.
Well, that's right. Hindalco had their annual investor meet, and they've laid out their strategy for the next few years. Remember, in yesterday's trading session, the stock went into this meet at the low point of the day. It was down closer around 3% or thereabouts. What are the key highlights out there? They're talking about Novelis in Q4 FY25 to deliver an EBITDA per ton in line with what they delivered in Q2, which means it should be in the vicinity of around $490 per ton, which is an improvement. That's good. They're also saying in the longer term, Novelis's EBITDA per ton will start moving towards $600 per ton. They laid out the path on that front. On their EBITDA front, they are targeting doubling their upstream EBITDA. And on their downstream EBITDA, they're talking about it going up by close to around 4 times. Now, that's very, very good operationally. On their capex front, they're saying that Novelis's growth capex will be at around $5 billion. That was known. However, various brokerage notes like Phillip Capital, they have highlighted that for the India business, the capex actually has been increased from $1 billion to around $5 billion. And normally in the past, you have seen that the street gets a little bit skittish when the capex number moves up. They also say that they have a strong balance sheet, cash flows are going to be pretty good, and they'll maintain their debt to EBITDA at around 2 times on a consolidated basis. Remember, the India operations as of now are debt-free, while the debt is only sitting in the Novelis business. Phillip Capital, they have a buy rating, target price of around 760. However, they point out that FY27 is going to be the big capital-intensive year where they'll spend close to around $4 billion. That's $2 billion in India, $2 billion in Novelis operations as well. And that's what could throw up some cash flow mismatch, which is a bit of a risk. So that's the low negative in this analyst takeaway. Otherwise, even Citi, they have a buy rating with a target price of 725. So that's Hindalco. Yesterday, the stock went into this analyst meet at the low point of the day. So maybe that's saving them the blushes. But otherwise, this capex number is something that bothers the street.
1 to 5 billion.
Yes.
That's a big increase.
On the India
India
business.
capex,
Yes.
yeah. So we'll watch out for that. Got it. By the way, two stocks we should not lose sight of. V-Mart Retail and CSB Bank. Both are reacting very well to their quarterly updates. Both are up 4.5%. V-Mart, remember, the growth is 17% on the top line. Same-store sales growth is 8%, which is better than what they did in Q3. And CSB Bank is blowing the lights out. 30% growth in advances, 24% growth in deposits. So market has really taken note of these quarterly numbers. But let's talk about some other broker notes, which are looking quite interesting this morning. Yeah, and by the way, a reminder, we are chatting with Mr. Agrawal of V-Mart on those, of course, really good-looking numbers for the fourth quarter and the outlook ahead. That's coming up at 9:50. Stocks holding up 4.5%. Let's also talk about Premier Energies as well as Vari. Vivek is joining in. Vivek, there's a slightly negative broker note out on these stocks.
Well, that's right. A cautious stance coming in from Bernstein as far as the solar PV space is concerned. So Bernstein has written a very interesting note. They've initiated coverage on two of the stocks, both Vari as well as Premier Energies. Now, both of them, they have an underweight rating, and the target price for Vari is at close to 1,902 rupees a share. For Premier Energy, close to 693 rupees a share. What is it? Number one, they actually like the business model. They also like the fact that both of the companies have made smart moves at the right time. So, number one, smart investments have been made. They are pioneers as far as the India's solar PV space is concerned, and potential, especially in the near term and coming quarters, is actually quite promising. What is it that makes them quite cautious on the space? They say that they recognize supernormal returns won't last indefinitely. So on the back of that, companies are actually diversifying into energy transition areas such as batteries. Why do they have an underperform rating if they like the business model? Number one, the cycle positioning is such that there could be significant competition coming in, expectations of deteriorating returns from this point on, and also the high valuations at which the regulatory arbitrage-based businesses, so that cannot be justified at such high valuations. They also say that the industry currently is at close to cyclically peak returns. This on the back of the fact that the retail prices currently in India are almost 2 to 3 times the global levels, and also the export at which the company does is significantly higher. There is very low entries to barrier. On the back of that, they expect much larger and deeper pocket players to enter this particular industry, and they expect, number one, it's too early to give a credible value to new ventures, especially with large conglomerates entering the space. So overall, they are positive on the space, but they're quite cautious, especially when it comes to share price returns from this point on the back of deteriorating returns that they expect, given the fact that it's cyclically peak.
All right. Nice wordplay and title of the report: sand, gold. Price of gold, value of sand. We'll talk about we'll discuss this in greater detail with the analysts concerned. But Vivek, thank you very much. Market open right on cue. 23,210 is where the Nifty is at, about 1/3% higher. The Nifty Bank is up about 0.5%, 51,065. The small cap index is that down 3/4? It's showing 0.75% lower. Okay, no, I think that's changed. 0.14 higher on the small cap index, more like it. The mid cap index will come up on your screen next, and that'll give you an indication as well. About 0.16, 0.15 higher on the mid cap index as well. So it's a pretty decent start. But last 2-3 days, go back to last I think Thursday, Friday, and this week of course as well. The open has been pretty useless in trying to predict how the close actually has been. Because you tend to see a fair bit of shifts coming through. So we're going to watch this one. It's almost equal number of gainers and losers cut in the middle, and the heat map, Nifty heat map, is giving you that sense. 40 points though for now on the Nifty, 23,200. Let's do stocks now, Surbhi.
Okay, Tata Consumer. We should maybe get Nivesh back, when he was just telling us about that report. The Goldman Sachs upgrade. The stock is flying 6.5%. I went back and just checked the numbers. Goldman Sachs is saying that FY26 EPS will be higher by 3%. Next year, they've increased it by 7%. Look at the stock, 6% higher. As we're seeing, the target is, by the way, 1,200 on Tata Consumer. And that's the best performer on the Nifty. Let's move on and see what else is working. Infosys, Tech Mahindra. There's some buying in large cap, auto, some of the other larger stocks like ICICI Bank, HDFC Bank also holding up. There is a little bit of a positive move on Trent again this morning, 0.7% higher. There's ONGC, Apollo Hospitals, Titan. It's a whole mix. ITC, lots of stocks moving on the upside. The downside, Nestle's fall is a little pronounced, about 3% down on Nestle. Even Lever is down actually. Lever's down about 1.5%. These two names from the FMCG basket. BEL is continuing to cool off as it did yesterday as well. And there's some weakness in Power Grid as well. So a couple of these PSU names are cooling off. But the stock of the morning definitely has to be Tata Consumer, still up almost 5%.
Well, that's right, Tata Consumer, that one's bursting away in trade. On the flip side, Nestle is down close to around 3%, so that's coming for some profit taking. BEL as well down close to around 2.5%, so that's under some pressure. And HUL is another one that's on the losing end, which is down close to around 2%. What's doing well actually today is the tech index. Let's pull up the tech index. The Nasdaq did relatively better overnight, and the street seems to be taking a cue from there. Infosys is up, Tech Mahindra is up as well. Both of them doing pretty well. HDFC Bank, yesterday the stock went, ended the day at the low point of the day. That's the fear with regard to the quarterly update. For starters, at least it's up close to around 1% or thereabouts. From the broader markets, what's under pressure? You have Central Bank of India that's down 10%. So big downtick is what you're seeing out there. ITC Hotels, the stock is down 2%. Yesterday, towards the end of trade, it went higher on very, very large volumes. So I'll be interested to see what happens on, ITC Hotels. From this point on, it's down close to around 2% or thereabouts. But otherwise, a good start to trade, a bit of a flip-flop from what we saw yesterday. Yesterday, you had the index that was under pressure, but you had the broader markets that outperformed. Today, it's a bit of a role reversal. Mid-cap index is down close to around 0.2%, while the headline index is higher.
Absolutely. And 50 points now, I think 23,212 is where the Nifty is trading at. Maybe just a few more names. Actually, by the way, 1,400 stocks are lower and about 800 stocks are higher at this point. I mean, all these Vari and the Solar Premier and, these are all down between 2 to 4% or so. Dabur is down about 2%. That's coming up with some volumes. I think we will be speaking with the management of KEC in a bit. Sorry, I think 2% lower, 775 on KEC. It's got some volumes as well at this point. Nestle is down about 3%, stocks at 2162. And of course, I think we already mentioned Central Bank and BEL earlier. So those are other names. Quest Corp, maybe on the upside. 6% on Quest Corp is the number two volume-led gainer on the across the board. 701 or so on Quest Corp. There is AG's Logistics, which is up about 4%. Lodha, that is Macrotech, is coming up with about a 2% pop. It's got decent-sized volumes for this point in the day. And Credit Access is another one, which is up about 1.5, 1.7. But, I mean, still 9.8, 970, 980 in that zone. V-Mart is up 3%. Stocks at about 3,045 at this point. But it's got no real volumes at all right now. So
I'm just checking Central Bank of India. Let's pull up the stock. Yeah, I mean, and I was just checking my screen is wrong, but 9-10% down on Central Bank of India. A little unusual, yeah. I checked it from the exchange as well. Indeed, that's a sharp knock. We'll just look into it and see if there's anything very specific. Otherwise, I mean, some of the other banks where updates have come out, like CSB Bank, they've been doing pretty okay. CSB, I think, is still holding up. But yeah, I just wanted to point that out. It's a bit of an unusual move on Central Bank of India.
All right, well, let's welcome in Tridib Bhattacharya, President and Chief Investment Officer, Equities at Edelweiss Mutual Fund. He's with us here in our studios. Tridib, good to see you.
Good to see you in
person.
Thanks for having me.
So, how are you feeling about the market and in stock picking? And I mean, what have you been doing? Give us a sense through the course of this year.
I think if I were to summarize the market today, it will be receding macro uncertainty. Earnings still uncertain, but at this point in time, I would say that expectations are reasonably benign. So a combination of all of these three is what we are seeing market, where I think
which is the first one? Receding macro uncertainty.
Yeah. So I think with the Trump, whatever he says today or in a week's time, we are almost ending a year and a half of macro uncertainty, starting with Indian elections, its impact on earnings, and now Trump and his impact on earnings. And after this, as we move on, the earnings start to take precedence. It will take some time to adjust, which is why I called out uncertain earnings, particularly in this result season. But if you give it 1 or 2 quarters, I think earnings will also start to come back. Net in FY25, putting all of these together in numbers, we started off with expecting roughly about 15% growth in earnings. We are going to end up being practically flat. So almost about 12-13% cut in earnings. And as we head into FY26, by the time we end it, I think we should touch double digits. So it's basically an earnings reset summarizing macro uncertainty and gradually making a comeback. So that will be my summary of how I read the situation right now.
All right. Hi, Tradeep. Good to have you in the studio. But you think the street is prepared to look through a weak showing in Q4 earnings? Because it's not going to be great. However, the commentary could be very, very good. And the low base effect will play out from there on, Q1, Q2 as well. So looking through Q4, that's par for the course. That's okay?
I think it gets very company specific from here. Like you read out some of the stock specific movements. If it is within a range, would be probably taken okay.
Yeah.
But if it kind of beats or misses beyond a particular 5% range, would be kind of I think you would see severe reaction onto that. I still think that market this result season will miss the gunpowder of earnings.
Okay.
Earnings upgrades, which have sort of lost our mojo from roughly about September quarter onwards. I see that coming back maybe June or September quarter this year. Till that point in time, we might get into a bit of a time correction, get of a flattish market where we have to kind of live on stock picking to kind of outperform the markets. And from there on, we start to take off, would be my read.
All right. So you're saying the street is prepared, that Q4, no great shakes.
Yeah.
Since there's so much of uncertainty with regard to Trump's tariffs, or call it tamasha, whatever, whichever way you like to term it, let's talk about domestic-facing themes.
Yeah.
The real estate space is something that you've liked in the past.
Yeah.
Both the core real estate players as well as the ancillaries.
Yeah.
Do you think that theme is good for more?
I think, first of all, it has done quite well over the last couple of years. And I think we are in the twilight zone where the second part of real estate, which is the ancillary sectors, like, for instance, building materials, which haven't done well at all, they might actually see a bit of a time in the day over the next couple of years.
Right.
So I think real estate builders is what you probably talk about as the primary beneficiaries of real estate theme, have played out more or less. There's some more remaining to come. But I think where valuations are reasonable are in the building material space, which should pick up over the next couple of years, is where I have my eyes on.
Okay, that's quite interesting. Let me actually build on that, Tradeep. So a combination of reasonable value and reasonable growth. One pocket you've identified, building material, allied real estate plays. What else?
I would say that there are pockets within quite a lot of sectors where there is value. So, for example, within financials, there is NBFCs, reasonable valuations, decent growth, and particularly if the regulation eases out a bit, they would stand to benefit from the same. I would say probably chemicals. They are making a comeback after 4 or 5 years of hiatus.
But isn't that still very risky? Because it's a fully globally, facing, globally linked sector.
It is.
Supply chains, etc., with so much going on. Would you still bat for chemicals?
Tactically, but because there is a price shortage, which is kind of, which is leading to buoyant prices, which will benefit the sector.
And which kinds? I mean, it's a very large basket without getting into names, but generally, I mean, are you looking at pharma intermediaries, or would you be looking at the whole fluorine chemistry part of it? Any particular?
Chemistry mostly.
Fluorine chemistry, got it.
And whatnot. And thirdly, power. I think within subsegments of power, where companies can have a bit of a moat and make margins, I think that's the place to be. So those would be 3 subsectors, not big sectors, where I think money could be made in the next year or so.
So pharma, NBFCs, and select chemicals.
Yeah.
Got it.
Any names in pharma? I mean, just for educational purposes.
We'll keep the education out. We'll limit to sectors. But I think one of the other things which I do see in the market happening is basically shifting profit pools. I think what's happening is there is competition coming in almost every sector from different directions, which will take supernormal profits out. So I think the other way to slice and dice your question is over the next 1 or 2 years, the execution kings within the sector would actually stand to do significantly better than others. Because as outsiders try to want a share of the profit pool, and I mean, of late, we saw in wire and cables, the pharma sector with the GLP-1, and many different kind of, such incidents. I haven't seen in my last 25 years in one go so many sectors impacted by disruptive forces at a time. So interesting time ahead.
What about the telecom space? Suddenly we're going to be getting used to a 3-player market. I mean, the third one's going to survive. The government of India is now the largest stakeholder in there. What do you make of that? I mean, will you look at the one that could survive, the core telecom player, or the other large conglomerate?
Quite frankly, having done a bit of global investing, telecom has not been a great place for investors. A bit like airlines, as Buffett would say. So within this, I think there is one large incumbent which will stand to benefit from that, maybe slightly higher competition in the near term. But on net balance, what's happening is really kicking the can down the road. I don't think it's a solution to the problem of the troubled entity that you're talking about. On net balance, I think the incumbent player should stand to benefit from the same.
The core player.
Yeah, core player.
Okay, all right. Since you spoke about aviation, there's one core play over here. And Interglobe Aviation has seen a big run. You have crude oil prices that are benign, which is good for them. Yeah. And I was just doing a rough check the next few months as well. Airline fares are going through the roof.
Yeah.
Do you think that's going to hold them in good stead? It's already had a big run. It had a dip when you had a couple of entities selling. But those dips are getting bought into. There's plenty of appetite.
Yeah.
Your view?
So my sense is that luxury, and this is, of course, there is a value into it, but luxury, travel, leisure, hotels, these are the place to be in the next couple of years overall.
Good for more even from here?
Good for more even from here. Because I think if you look at even the hotel sector, for instance, the people expected the prices to peak out a couple of years ago, but actually, if you see today, even them, they are kind of rising as we speak and have further room to go.
Yes.
So I think net hotels, hospitals, less so aviation, I must admit, are places where I think a few other pockets where structurally money could be made over the next 2 or 3 years.
And you're not too uncomfortable with the valuations there? I mean, especially after this correction now?
Yeah, so valuations have become reasonable. They will not be die-hard cheap because obviously there is economic momentum in there. You've got to pick your spots, but within that, yes, I am comfortable with a few names. We hold it in our portfolio.
I completely agree with hospitals. Hotels, I don't know. Hospitals, I agree with. I mean, hotels also, they've done well. Why not, right? But hospitals...
See, you have to go to one place by force. The other you go by choice. But eventually you have to sort of deal with both.
A friend of mine was saying that instead of buying insurance policies, obviously it's not serious. I was just joking. Might as well buy stocks, right? I mean, you'll healthcare costs rise, 10, 15, 20% every year?
Yeah, it's huge.
And you got
premiums have been shooting higher.
Maybe some appreciation in stocks as well, which takes care of the cost. But of course, as I said, buy your healthcare insurance policies, absolutely. But what else, Trideep? You're not sounding, it's sounding, you said interesting times ahead. Sounded to me like tough times ahead, Trideep.
I think for it's old school bottom-up stock picking time ahead. Basically, that's what I mean. The easy answers, the big themes, the manufacturing themes that like played out,
done, dusted.
Those are kind of are themes of yesterday. Going forward, and as I said, the profit pool are shifting within the sector. So which spot you pick within the sector is important, and then a couple of shades, where a little bit of momentum is there from a sectoral theme standpoint. So it's basically die-hard stock picking, and hence I am sounding a little kind of, the easy pickings are done. It's hard work ahead.
The rising tide is now flattened.
Correct.
There's no.
He's actually sounding a little optimistic to me because he's brimming with ideas. And like you're saying, this is, I think, is going to be the period that will separate the men from the boys in terms of fund managers. So very interesting times ahead. Having said that, just a quick final question from my end. So the general wisdom in the market, if you ask, 8 out of 10 people will still tell you that don't go to mid caps, large caps is the way to go, etc., etc. But let's face it, we need some mid caps in our portfolios as well. Now there, what is the approach? Where do you see still too much of over exuberance? Where, which are the interesting mid cap opportunities?
So I think first, I must admit that when I look at a business for stock picking perspective, it's very unlikely that I look at large, mid or small. We look at the quality of the business, the moat that it has and the growth prospects and whatnot. And in that context, in some of the subsectors that I mentioned, the largest companies are actually mid-caps.
Mid-caps, yeah.
So, and you could call them mid-caps and hence higher exposure to mid-caps. But overall, I think, as I said, there are certain segments within mid-cap domain which are hardly there in a large cap. For example, if you look at hotels, hospitals, and
even chemical companies, it's all mid-caps.
Chemicals or capital markets. These are not part of large caps at all. So for you to hunt in these spaces, you've got to kind of dig deep down as well. And I think that's where I was meaning that one has to deep dive to get to those pockets where there is value, and hopefully kind of, we can tide this period through. So
without
that's
the
my
tide.
recipe.
tide this period through without the tide.
Without getting swept away.
No, I mean, but yeah, it's. I think Sanjeev Prasad was with us yesterday, and he was also making the similar. I mean, the competition is we don't talk about it too much, right? We talk about companies and what they can do, but so many sectors seeing disruption, extra competition, etc. So. Have to take note of all of that. Thank you very much, Sudeep. Appreciate your time here.
Pleasure.
And thank you for dropping by
to
the studios. I think, the market, by the way, the Nifty, it flatlined and then now we have a 100-point gain. So it's a bit of a, already we've had quite a bit of a move on the Nifty index from the opening level to the low that we saw. So, I think we were up just 10 points at the low, and now being up about 100-odd points on the index. Market breadth is still slightly negative. 900 stocks are higher and about 1,500 stocks are lower to sort of begin the session. Nigel.
All right, well, let's talk about KEC International. They bagged new orders worth around 1,200 crore rupees for the T&D projects in India and West Asia. To discuss these order wins, their business outlook as well, we're joined by Mr. Vimal Kejriwal, the Managing Director and CEO at KEC. Hi, Mr. Kejriwal. Good morning. Thanks a lot for joining in. Well, give us a few details. What was the total order inflows that we saw in Q4? And if you could tell us, for the year, it appears you have surpassed the guidance that you've given on order inflows. What was the number you're ending at?
So Nigel, I think Q4, if I'm not mistaken, we're around 6,000 crores of order intake. We are still L1 in some of them. People are saying we'll issue it on 31st. Let's hope that we do it. But anyway, we are very close to 25,000 crores. We are not surpassed the guidance in that sense because we are slightly below 25. Okay, we had said we'll do 25,000. And if you look at these orders, 55-60% is from transmission, and then civil, and then cables. I think that's the broad breakup of this particular order.
Okay, all right. And what about for the coming year? Since you're saying you're L1 in some positions, could you tell us, could you quantify the book at which you're L1? And for FY26, what kind of an order inflow are you looking at? What does this take your current order book first to?
So our order book plus L1 currently is around 38,000 crores. Okay. And it will go down slightly because we'll still have to factor in what would be the March revenues, etc. So I think broadly we'll end up around 37,000, including L1 for the year. That's our expectation. We expect to grow around 15% or so next year. So we are still working out an order intake target, but it will definitely be 30,000 crore plus.
34,000 crores plus. Okay. All right. I got that, Mr. Kejriwal. Great to have you on. Just going back, I mean, looking at the overall environment and how you're looking at the bidding pipeline ahead for this year, FY26. I mean, we've discussed this in the past that, the margin profile didn't improve as much as you would have liked it to in Q3, but you've always been maintaining that FY26 and 27 will be much better from a margin expansion perspective. I mean, you've been talking about levels of maybe even 9%. So looking at the bidding intensity, the pipeline, are you still confident of getting to those levels?
So to me, what is happening is that bidding pipeline is definitely increasing. We've always been talking about around 140,000, 150,000 tender pipeline. Right now it's gone above that. It's almost 170,000, 175,000. A large part is driven by Middle East also, and also especially Saudi. Also, we are seeing water projects which were on hold getting sort of bid out. So some traction we are seeing on the water side also, which is why the bidding pipeline seems to have increased by 25,000 crores as compared to last time. Margins, I think we are pretty comfortable. We have given a guidance next year of 8 to 9%, and I think we are pretty hopeful of doing that because a large number of legacy projects are getting over or have got over in FY25. So I think 26 and 27 should definitely be better on the margin side.
Okay. Which of the segments, I mean, where you're likely to see maximum traction? Of course, I mean, the last couple of orders, you've managed several orders from the Middle East as well. In India, I mean, in all our past conversations, you've been telling us that obviously the T&D segment has been doing well. Railways was weak. So now, as you sort of look forward to this year, let's say talk about the next 4 to 5 months at least, which segments will drive the order book growth?
So primarily it will still be T&D. Even this year, out of our order intake of roughly 25,000, 72% is T&D. And if you look at that number itself, T&D, almost 60% is international and 40 is India. So although we understand India T&D much more and we track it much more, I'm just generally saying that T&D International also is doing very, very well. So T&D will clearly drive. Second piece will be civil, which was a bit, I'll say, low this year on order intake. We do expect that to, I'll say, go up significantly, especially driven by residential and the water piece. And we're still seeing a lot of traction happening on the metals, mining, etc. So most of our orders in industrial have been on the steel side. Okay, so I think these are the three areas which we see driving our order book next year. Or sorry, FY26.
Okay, so T&D remains the primary workhorse.
Yes.
Metals and
Yes.
mining. And also civil construction opportunities with real estate seeing hectic activity. Got that.
Yes.
Final question, sir. Again, and this is coming from the past where you spoke about labor issues that were sort of becoming a bit of a challenge to deal with. Has that sorted out?
So let me put it this way. It is sorted out, but we are trying unconventional means, etc., which were not been like, we were never using labor aggregators, contractors like that. So we have started using them. Obviously, the mechanization has picked up a lot. So we are trying to see how do we sort of optimize the need for labor. It's improving. I'll say it's slightly better than the last quarter.
Okay. Good to know. Thank you very much, sir, for joining in. We'll, of course, connect again once the Q4 numbers are out, and we'll have more questions for you. But thank you very much for joining in this morning. That is KEC International with sort of an update on their order book. They're saying 25,000 crores was the target, maybe just slightly shy of that. That's how they will be closing out FY25. Let's move on and get you our special segment, Young Turks Reloaded. Shireen sat down with PVR Inox's MD Ajay Bijli to look back at the incredible journey from a single-screen theatre to India's largest multiplex chain. Ajay speaks about how he plans to adopt an asset-light model for new cinema expansion to improve margins. Take a look.
On the consuming habits changing,
Yeah.
and what this potentially now means as far as occupancy is concerned. It's been stagnant at around this 25%, 25.7% for the last
Yeah.
quarter is the occupancy levels. What do you do now to drive footfalls? Because the experience is in your control. The content is not. You can't do anything about the content.
I'm still as sanguine and optimistic about the business. So when I go and look deep into what happened 2021, 22, 23, 24, 24, 25, which is going on just now, the number of movies, first of all, got reduced. Only 85 Hollywood films got released, as opposed to 174 movies. This year, again, the number is going above 150 because that screenwriters strike and
Right.
all that
Yeah.
happened. So if the movies become 175 or 174, that means you've got more content.
Yeah.
The chances of hits and misses will always remain.
Sure.
But because
Hopefully more hits.
So our businesses in India, this is the only market I'm comfortable with, is a volume-driven business. Volume in consumption and volume in supply. So therefore, if one or two movies don't do well, doesn't bother me, because you'll always have a sleeper hit that makes up for a movie with high expectation that gets compensated. So I think because the movie flow coming in, it'll be more appealing even to the consumer. Even in India, a lot of movies got bunched up in 23 and 24 because shootings had stopped. So Shah Rukh Khan, 3 movies got released in 1 year, which is unheard of. Amir Khan, no movie has still got released post-pandemic. Ranveer won, Hrithik only won. All these guys also, to be honest with you, and obviously that's my supply side, were also a little figuring out what does the consumer want. I think now they've got their act together. A lot of work got done on the script. And as I say, it has to be on the page before it goes on the stage.
Yeah.
Sorry, I'm quoting these
No, please quote away. More dialogues. We are in a movie theatre.
So I think a lot of time is getting put on what's on the page. And I feel that this 25, 26 onwards, these occupancy levels that we're talking about are bound to improve. Because the supply side
But hope
is looking...
can't be a strategy, right?
Hope is not a strategy.
Yeah.
So what we are doing is a couple of things. I'm saying, okay, if we reach the 31% level, excellent. If we don't, let's align all our costs and our strategies to 25, 26%.
Right.
Okay.
Right.
So therefore, one is that FOCO model.
Yes.
I've already spent 5,200 crores on this circuit by inorganic and organic.
Yeah.
So we are only doing what hotels have done all their lives.
Yes.
Okay. Get basically monetize the brand.
Yeah.
And have
so somebody else sets up the infrastructure, you run it for them.
Correct.
To put it simply.
Absolutely.
Yeah.
And I must confess that I've been fortunate enough to meet a lot of chief executives of Trent, various other Titan, hotel like Puneet Chatwal. I've exchanged a lot of notes. Nobody in the exhibition business has done this globally. First time in India, this has been done.
And first time worldwide?
Worldwide,
okay.
yeah. So we're very fortunate, and some of the developers, have been incredible. People like DLF, I don't mind mentioning them, I'm a big fan. They've also realized that this is the model to go. Cinema is a necessity for their shopping centers. They will invest some money and we will manage it. And in smaller towns, tier 3, tier 2 also, we've had this response. Like people feel very proud to be part of a hotel.
Right.
People own a hotel or a Tanishq.
Yeah.
Or a Titan or a Zudio or whatever. Similarly, they have this pride that, PVR is mine or an Inox is mine, and they spend the money. We've had to spend more money on our SOPs, brand, and what we bring to the table. So that's one thing that we've done to make sure our ROCE improves.
Yeah.
If we can do more and more screens, around 100 screens got signed last year. This year also about 100 odd screens.
So who are these developers who are coming on board for the 100 screens that you've already got in play and the additional that you are looking at?
Mix of people who are organized and unorganized. One are just one off, two off, in Jaipur, Udaipurs of the world, Nandeds, Ujjains, Indore, Kota, these kind of Ajmer, these kind of places, and then big ones who definitely need a cinema, and then they are also. So a mixed bag, but we've got a tremendous response.
So what does it mean in terms of additional revenue? Because, on the back of the management fee that you're going to be able to get in from this.
So initial fee, technical fee, and then management fee, that is one. That's one model that we're doing. And then line by line costs, we're looking at, and also all the new deals that we're doing are on revenue share. That will make sure that the volatility taken care of. So the minimum guarantee are paid, but their minimum guarantee is not very high rentals. And also when the business is good, then they share the spoils with us because we give them a revenue share. So that's one model. Other is line by line, zero-based, costing of every single, whether it's manpower, marketing, electricity. We're looking at a lot of solar to help us bring the cost down. So we're saying that if we, even at 25%, if we can get those margins that we were getting pre-COVID, we are okay. But if we do go back to the occupancies we were getting pre-COVID, then fantastic. That's all gravy. Other than that, the 3 Fs that I spoke about, I'm saying that we already have an infrastructure. We have 15 million square feet, in India, which is, by the way, I think the largest for any retailer. I think so, I've been told. Why can't we use those spaces for alternative kind of entertainment? So that's the fun part.
Yes.
Some by repurposing the cinemas, some without repurposing. So if we're showing IPL, we don't need to repurpose. If we show Taylor Swift's Eras tour, we didn't have to repurpose. BTS, we didn't need to repurpose. A comedy, stand-up comedy, whatever, all those kind of things. We did something called Candlelight show. Those are without any repurposing.
Right.
There's one more strategy that we're doing. We're doing about 4 pilots just now. One in Bangalore, Gurgaon, Bombay, everywhere, where we're repurposing certain cinemas, creating green rooms, having bleachers where your seats can, combining 200-300-seater cinemas into one seat, this thing, and doing gaming.
Okay.
Going, and by the way, everybody is not Ed Sheeran and Coldplay or Diljit Dosanjh.
Yes.
You have so many artists who are happy with 1,000-seating capacity getting filled up. So I'm, as you know, fond of music as well.
Yes, we know.
So I'm in touch with a lot of artists, a lot of managers. There's so many artists.
So you're getting into the kind of Book My Show, Zomato district kind of space?
Only providing the infrastructure.
Right.
So I don't want to do something that I can't. There are experts who are doing it, whether it's district or whether it is...
So do you tie up with them?
We tie, they can, sell our tickets. And so that's the fun part. Where can we repurpose our cinemas? Some amazing things are happening on some of the projects which are basically still under fit out.
All right, so that is PVR 2.0, how they're reimagining the business given the new environment. Young Turks Reloaded. You can catch the show, which is going to be coming soon on CNBC-TV18. All right, time now for a quick break. Up next, Anup, Vadhavan, former Commerce Secretary, as well as Abhijit Das, international trade expert, will be joining in to talk about what Trump's new tariffs could mean for India.
Okay, welcome back. We're, of course, talking about Trump tariffs. Tonight is the moment of truth when we will know what President Trump wants to do as far as tariffs are concerned. And tomorrow morning, of course, we'll be reacting to it. I just thought, before we dive into our next discussion, put two data points on board. One is, what is the impact on India? I mean, of course, it depends on the tariffs which are imposed. Now, JP Morgan economists say that the difference between the tariffs which India imposes on the US and US imposes on India on a weighted average basis is about 8%. So, I mean, if the increase were to be just that, 8%, the impact would be about 20 basis point hit on GDP. If JP Morgan economists say the Trump administration decides to include VAT of 18%, you're essentially looking at an impact of 50 basis points as far as GDP is concerned. So, I mean, this is data points as we are looking at it. And of course, this does not include what India is already offering. As Parikshit has been telling us, and our Delhi reporting team has been telling us, there have been hectic parleys and proposals, and maybe more firmer kind of proposal is being readied. Maybe it's been discussed with Trump administration, and Trump, of course, is on record, and they've said that some of this stuff is indeed happening, and they will be sort of taking note of it. So we don't know the reaction function, and of course what Trump is going to make of it, and then sort of will that mean a carve out in some sense for India, etc. So without knowing all of that, I mean, this essentially are the numbers. This is this particular table is sector-wise exports to the US, ranked by the contribution to the GDP. India's exports to US percentage GDP. This is tariffs imposed by US and India, and this is tariffs imposed by India on the US. So the way to do this is basically you take this number, subtract that number. That is essentially the difference, which if they're going to be purely reciprocal, and if they go sector-wise, I mean, you get a sense of where the hit is likely to come. And here, and taking into account contribution to GDP, there are three sectors which are in focus. One is pharma, the other one is textiles and clothing, and the last one is agri and meat products. I mean, here the difference is the largest, and the contribution is not very small. I mean, it's still small, but as relative to some of the other sectors, these are the three areas, these are the three sectors where perhaps the impact looks higher, perhaps they are more vulnerable as well. So let's, with this short kind of sort of setup or a preamble, let me welcome in Anup Vadhavan, former Commerce Secretary, and Abhijit Das, international trade expert and former head Center for WTO Studies. Thank you very much, gentlemen. Appreciate your time here on CNBC-TV18. Mr. Vadhavan, if I can start with you, sir. You must have seen news reports about proposals being readied here in India to lower tariffs. What can we here in India in terms, offer? I think the deficit is about to the tune of about a little over $40 billion as of the last financial year. What can India offer to offset, to preempt some of these tariffs, which are going to be announced later today? Go on.
I think, that is not very consistent with our intention to have a bilateral trade agreement negotiation in good faith. So there is a view that, that might be kept in mind by the US. We had a very successful visit by Mr. Brendan Leach recently. And so there is some conjecture, perhaps with significant basis, that the US might realize that, these reciprocal tariffs and the acrimony associated with them and the tensions associated with them are not consistent with the good faith, bilateral trade negotiations. So it is still conjecture as to what will happen, and as to what India can give will all be part of the negotiation. And typically trade agreements are balanced. You give mutual concessions which are commensurate with each other and balance the trade agreement. So certainly, areas of U.S. interest, they have some interest in things like, motorcycles and.
Vadhavan, if I can come in, you're saying the lowering tariffs now will not be consistent with trying to strike a bilateral trade deal. Is that what you're saying?
Absolutely. All that has to be negotiated as a matter of give and take in the trade deal. Where trade deals involve give and take. You take American
Vadhavan, but the point is, so you're saying take the reciprocal tariffs as they come, that's more consistent, and then negotiate a deal separately. That's the way to do it.
What I'm saying is that reciprocal tariffs should not come. If better sense prevails as it should, reciprocal tariffs should not come. Quick trade negotiation should happen, and you should reach an early harvest agreement on goods of interest, which both countries have in their wish list. So that is what I'm saying.
So it's possible, Mr. Vadhavan, you're saying that if better sense prevails, I mean, now who knows, but it's possible later today when we hear about countries where this will be imposed, you're saying it's possible the Trump administration says since discussions with India are in advanced stages and they're happy about what they're seeing, we're going to hold off in terms of tariffs on India. It's possible.
It is entirely possible in my view. Let's see what happens. If reciprocal duties are imposed, we have to see what the levels are, what the goods are on which they are imposed, and then we'll have to take stock of that and suitably react to it. So that becomes a separate channel away from that trade negotiation. That has to be dealt with separately, and let's see what happens.
All right, fair enough. I mean, I think that gives a fair sense. Now, let's welcome in Abhijit Das as well. Mr. Das, good to have you on the program. What is your sense? You heard Mr. Vadhavan.
Dr. Vadhavan has given one side of the picture. No doubt that there is a possibility that India might be spared of the reciprocal tariffs. But to my mind, that possibility is rather low. If we look at President Trump's statements over the past 3-4 days, it doesn't give me much ground for optimism that India will be spared of the reciprocal tariffs. If India does have to confront reciprocal tariffs, then this clearly, to my mind, would be something like a breach of good faith, since India and US are already engaged in the bilateral trade agreement negotiations. It would be prudent for US not to impose the reciprocal tariffs. But as all of us know at this juncture, prudence doesn't seem to be the order of the day. So to my mind, the possibility is fairly high that India will be at the receiving end of reciprocal tariffs. What will be the extent? What will be the sectors? I'm sure we'll have to just wait for a few hours and then we'll get to know where we stand on reciprocal tariffs. But as Dr. Vadhavan said, if we are confronted with reciprocal tariffs, then while the BTA negotiations continue, we must not hesitate in trying to protect our national interests. And one way to do it would be to impose some tariffs from our side as a signal mainly. Otherwise, if we don't do it, then in the bilateral trade agreement negotiations, much of our negotiating capital will be spent in getting rid of the reciprocal tariffs, whereas in the BTA negotiations, our endeavor should instead be to see if we can secure new and additional market access in the US in sectors like textiles and clothing and leather.
Gentlemen, I also want to draw your attention to the remark that Mr. Trump made overnight. He said that, and I quote, "I heard that India is going to be dropping its tariffs substantially." So I don't know. I mean, the fine point or the finer points will only be revealed once those trade negotiations are done. Because tonight we'll only get the US number. And what is India willing to relent on, that we have to see. But some signs are already there. For instance, bourbon whiskey, cars, all that is already up in the air. So Mr. Das, if you could come in on this, which could be some of the product lines, tariff lines, where if we cut a little bit, it will not hurt our trade interests too much? Which could be those segments?
In the industrial goods sector, there is not too much that US can export to us. So one could be fairly selective, fairly targeted, and India could cut tariffs. But as Dr. Vadhavan said earlier, the tariff cut should not be unilateral. These should be accompanied with the United States extending tariff concessions on products of our interest. Otherwise, what will happen is if we keep on giving unilateral concessions, which we seem to have done so far, we will not get anything in return. US will only pocket those concessions. Bear in mind that these are negotiations, and in negotiations, it's a matter of give and take.
Yeah.
So we have to make sure that concessions which we have already made and which we might make in the near future, these are accompanied with reciprocal concessions from the US side.
Sure. So let me actually ask, Mr. Vadhavan, exactly that. So the common sense logic that one is hearing all around is that, let's say, pharma. And pharma imports into the US are really important for the US as well. I mean, getting drugs at reasonable pricing. So maybe that could be one bargaining chip, that they don't hike tariffs, import tariffs on incoming pharma products too much. And similarly, the same question I asked Mr. Das, where could India cut a little bit to appease the US maybe to an extent without hurting our own trade interests?
As Dr. Das said, America is not a major manufacturing nation. So industrial goods are not a major aspect of their exports. Of course, they have interests in motorcycles, two-wheelers, four-wheelers. They have some limited interests. So we could, possibly accommodate some of the interests with various safeguards. Typically in trade negotiations, you have, various measures like staging of duties. The duties don't kick in immediately. You can have a tariff rate quota where the concessional tariff is on some limited quantities so that your domestic industry does not get, hurt. Similarly, the other area is agriculture. So it's not a question of what we are willing to give. That what we are willing to give has to match with what they want. So we have to consider what they want, and typically they will want concessions on, two-wheelers, four-wheelers, agri products, dairy products. So we have to then see which are the things we can do comfortably, which are the things we can do with some sort of safeguard measures, maybe a tariff quota where there's a limit on the quantities that come in. So it's very technical, and we've done it before. We've done, trade agreements with more, significant industrial nations than the US, say Japan, Korea, ASEAN. So there is a method in this, and I'm sure we can, accommodate American requests while protecting our sensitivities and adopting various measures that can, prevent our industry from being hurt beyond an acceptable degree, let me say.
Let's see, gentlemen, very, very interesting times, whether our negotiators, and more power to all of them, people within the Commerce Ministry, whether they can walk this fine line between giving America a bit of what it wants while protecting, of course, our own Indian industrial interests as well, industrial as well as agricultural interests, of course. Thank you very much for joining in. Of course, this is an ongoing story, and live coverage will be starting a little past midnight tonight, and we will continue it well into the morning tomorrow. So, long hours coming up. But for the time being, let's shift our eye back to the market and corporate conversations. Market's holding quite steady, 60 points higher on the Nifty. Not too much of a problem there. Mid-cap is flashing a little bit of red for the time being. So with that, let's quickly get into our final corporate conversation on Bazaar for this morning. V-Mart Retail, like we've been telling you, the stock has been holding up. Last I checked, it was still up about 3%. Let's pull up the stock price on the screen. Can we do that? Yeah, there we go. Okay. It's cooled off a little bit from the opening highs. But the fourth quarter business update has been looking very good. 17% revenue growth, same-store sales growth at 8%, which is even better than what they did in the third quarter. Mr. Lalit Agrawal, founder and managing director of V-Mart Retail, is with us. Mr. Agrawal, thanks for joining in. It's good to hear, good to see, good to note, and you've been managing those growth numbers despite this ongoing, slowdown that is being spoken of. Tell us, what's driving it? Is Tier 2 demand still strong? And is it all volume, or is there any elbow room to look at pricing growth as well?
Hi, good morning, Survi. No, definitely there's a lot of work which has gone behind this, and we have been struggling for the last 3 years, but yes, this year finally has been a good year where we could achieve the growth back to what we wanted. So there's a lot of changes that we have done in the organization, but yes, definitely we are also seeing the mass consumption and the rural consumption inching up a little more, becoming a little better than the last year. And that also has driven some kind of consumption, especially in markets of Uttar Pradesh, Bihar, where we were struggling fundamentally. But I think, yes, volume growth is something which is very, enlightenment. We're really getting good news about that volume growth. And this is also being led by fashion, because there's a lot of fashion change which is coming to the market. And that is also something which is driving a little more consumption, because consumer now need a little different wardrobe in their house. These are largely also led by Gen Z and that particular population, that age group. That is something also that we are trying to drive.
No, absolutely. And full marks to you and your team, because this fast fashion category is also fast moving, right? Fast moving fashion. And it's fairly competitive as well. Lots of players in this space. So just tell us, given the strength that you've seen in the fourth quarter, and I think you'll be ending FY25 exceeding your guidance of 15% top line growth. Now, FY26, what is the kind of growth aspiration that you'd like to put in place? Volume growth, or rather, let's say top line growth, and same store sales growth that you would like your teams to deliver in FY26?
I think we definitely want to replicate this result that we have done in the last year, and we will want to have better outcome, because we are getting the grip over the business. We are getting the grip back on the fashion. There are a lot of competition which had walked into our space for the last 2-3 years. So now most of their effects have got neutralized. We are seeing them deperforming now. So I think we are gaining back some consumer. More consumers are walking into organized retail, which is a good news. And then consumers are also shifting bases from ineffective or improper retailer to a proper retailer, because we are trying to focus more on quality. We are actually trying to focus more on our repeat customers and our repeat customer sales to drive up to 75%, which is right now hovering around 70%.
Okay, all right. Hi, Mr. Agarwal. Good to see you on the show. The total store count, I think the net addition last year was close to around 50 stores?
Yeah.
53, I think so. So what
This last year, we have added 62 stores.
62
stores.
Gross
number. But we also closed down 8 stores. We also closed down 8 non-performing.
Yeah, that's how I come to the net addition of around 53 stores for the year, roughly. For this year, what kind of store addition are we likely to see? Point number one. And SSG, what should the growth number look like for this year? Last year, I think it was around 11%, which was relatively higher in comparison to what you were guiding of high single digit. No. All right, I think we've got you on a bit of a scratchy line, Mr. Agarwal. We'll try to get you back. Last year they added a net amount of stores of around 53 stores. That's including the additions and deducting a couple of stores that they are shut. I think we have Mr. Agarwal back with us. Mr. Agarwal, you're making that point. Please go ahead. Number of stores you're looking to add and SSG growth for the year.
Yeah. Of our square feet addition every year, we have been consistent for a decade, and then that is what we would want to again add. So maybe adding around 62 stores or 65 stores on net number. That is what we would target even the coming year. And then definitely numbers will definitely come back. And there's a lot of hue and cry going around consumption in rural, consumption in urban. FMCG companies have not been reporting too much. But yes, there is a lot of fight going on. The middle class and lower middle class consumers still don't have too much of money to spend on these areas. They are definitely gaining back. There is a lot of tax rebates that government has given. That is also helping the consumption. And we expect some more consumption coming in especially from the tier 3 and the rural areas. That is where we believe if those consumptions are back and monsoon remains good this year as well, we would definitely clock once again almost a double-digit growth. That is what we should expect from our team, and that is what we are all getting prepared for on the like-for-like.
Okay, all right. Thanks for joining, Mr. Agarwal. You've revamped your business, as you're saying. You've put in a big effort to deliver these numbers, and we look forward to chatting up with you at the end of Q4 numbers and then lay out the path for FY26. For the time being, we slip into a short break. On the other side, Manish Gupta is waiting for us to give us an update on the commodity space.
Okay, welcome back. Well, let's shift focus to what's happening in commodities. Manisha's here with what's going to be top of mind as we head into the tariffs day. Manisha, morning.
Well, that's exactly on top of the mind, the tariffs that is, and various asset classes clearly reacting to that. If you look at the Asian markets today, Prashant, we haven't seen much of volumes come in. The total focus clearly is on what kind of announcements we would be seeing. And in turn of that, we also are looking at weaker US data that has been coming in for the last 4 or 5 sessions, starting with weak US consumer survey data. The manufacturing numbers were on the weaker side. And then it also has been about the weakness in the jobs data that the markets are reacting to at this point in time. If you look at the Citi report, it says on US tariffs, that is, that the world, as we are going into that event right now, the best case scenario would be if we look at US tariffs between the tune of 5 to 10%, that is something that the markets or the world can live with. But the worst case scenario in their sense would be if the tariffs come in between 15 to 30%. That is when you will see that big knee-jerk reaction come into the markets as the US would be on there. There also is a report from Goldman Sachs saying that depending on what kind of tariffs we do see today, there is already a 35% of a probability building up of a recession in the US market. So that clearly is the narrative that we are going into the event with. In the meanwhile, when you look at the gold prices, well, we have seen record highs into this one, 10% of gains in the previous month and 19% of gains already in this year until now. It has been a string of all-time highs coming in for gold in sense of safe haven buying from tariffs, from geopolitical tensions, because the US dollar also has declined, and political unrest. All of that money seems to be coming in sense of gold. And most importantly, this is the reason that you have seen gold prices go up quite strongly in the previous week, is that the China gold ETF has added 233,000 ounces in the previous week itself, and China perhaps would be accumulating more going forward by their insurance firms. Supportive clearly. Take a look at the crude oil prices then, and we were trading at a 5-week highs yesterday, almost nudging that $75 a barrel mark. Now, markets are watching out for reciprocal tariffs, but in the meanwhile, it also is about the OPEC and allies meeting. That happens on 3rd of April, and an expectation that they could approve an output hike of 135,000 barrels per day from the month of May there. The US crude inventories also have surged slightly, and that also seems to be weighing onto the markets right now. But as I said, all of the data that has come in from US has been on the weaker side, from consumer survey to jobs data and to the manufacturing numbers. All of that has come in on weak. What the street will also want to watch out from here on is, one, of course, the tariff announcement. Then you have the OPEC and allies meeting. And then you have the US non-farm payroll data. Well, that comes in on Friday. So it promises to be a very, very eventful rest of this week.
All right. Thanks very much, Manisha, for that. It's absolutely eventful next 2 days, Thursday and Friday, after what we will hear later tonight. Well, it's our special segment, Indianomics. My colleague Lata will be in conversation with a host of guests to discuss if the Indian banking system is going through a structural shift that can keep margins and loan growth much lower than in the past. It's a very interesting chat. We'll have Dinesh Khara, S.S. Mundra and Srinivasan Varadarajan help us sort of understand this issue in greater detail. Stay tuned.